Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, February 22, 2017, looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. As you can see, nothing happened today. The SPDR was down 17 cents or 0.07%. It was an inside day, which means the high and low of today were inside yesterday's highs and lows. The market was uneventful today. The volume was extremely light, finishing up the day at 61 million shares below the average 90-day volume of 77 million shares. All in all, an extremely lackluster day out here in the market. No signal, nothing that we can hang our hat on. Still yet, higher prices do remain. I'm sticking with the next upside target, which is $238, and then the following one will be a little bit over $240. However, I don't think we get there on this shot, although I could be wrong. Nevertheless, nothing happened today that we can draw information from, giving us a hint or clues of what the next likely scenario is for the market. So we're just going to have to be patient, continue to be patient, play the waiting game, and wait for the market to give us the signal that it's ready to change direction or change character. The best possible scenario to identify a change in direction or a change in short-term trend would be for the market to gap higher in the morning and then have what's called a gap and crap. And for that gap higher to basically finish the day lower on volume, increasing volume as the market goes lower throughout the day. That's a gap and crap. That would be a signal of a trend change. That would likely be an engulfing candle or a reversal candle on volume. That's really what we're looking for. You'll know it when you see it, but again, and I repeat this each and every night, don't get in front of this freight train. Don't try and short the market and guess where the top is. You might be right once in a blue moon, but if you tried it 10 times, you're going to be wrong 8 or 9 of them. Let's move it along. The IWM. Now, the IWM was down a little bit today. It was down 0.4%, but again, there's nothing wrong with the market. We still remain above the old highs on a closing basis. The market is strong. It's just a down day of 56 cents. I can't really read any more into it than that. So I'm going to leave the IWM, and, if it was down more and it was substantial, we could start talking about divergences, but I'm not talking about divergences. We're not going to get in front of this market or even consider getting in front of this market until we have a trend change signal at hand. The next market we'll discuss is the VIX. And just to make mention of the fact that the VIX was basically flat today, but what you can see developing, and this is why I wanted to bring it up, is you can see a bullish pattern developing. Right now we're trapped in between the 50 and the 20 period moving average, but we have this big up green candle, and now we've just been going sideways for a few days after that candle. So if this pattern plays out, the likely scenarios will find the VIX up above 13, maybe even as high as the 200 period moving average. That would be a little bit outside of the realm of what this pattern would normally produce. It would normally produce a move up to 13 again, and if that's the case, then we would see a little bit of downward pressure in the market if that was occurring. But as it stands now, it's just a bearish pattern, bullish pattern, nothing more, nothing less. We'll watch it. I'm watching it day by day, watching the market for clues, but frankly, I'm looking for the big clue. All right, watching the VIX closely. Transports, next up. So the transports were down today. They were down almost 1%, which is a pretty decent down day for the transports. In the big scheme of things, they're not down that much. In the big scheme of things, they're bullish. They're above the moving averages, trading near the highs. There's nothing wrong with this market. It's just a down day. That's the way I'm going to look at the IWM. That's the way I'm going to look at the transports as far as a day like today goes, until we get the bigger picture, more clear picture of the bigger picture, I should say. Right now, the picture is up. The market is complacent, and that's the issue. There's a lot of complacency out there. The sentiment indexes are at extreme highs. You hear things like, ridiculous price targets, and that, any pullback would be very, very minimal at best and be a buying opportunity. Don't short this market. You can't get in front of it. Now, I've been telling you that, but we know what we're looking for. You're just getting random analysts, random market strategists parading on television telling you can't short the market, it's going higher. Those type of conversations usually precede a market turn, but we're going to need some kind of a spark. I don't know what that spark is going to be. We'll wake up one day and there will be a spark, or there'll be a spark in the middle of the day. It will be some announcement from the White House. It will be something relating to trade. It will be something relating to, God forbid, terrorism. It will be something relating to something that is unforeseen at the time, but will not come as a surprise, most likely. So we're going to leave the transports alone. We're going to move out of the stock markets because, frankly, there's just not a lot going on. The volume is so light. One index is up slightly, one is down, and frankly, there's not a lot of trading going on. So most of it is driven by the computers, and when the computers drive the majority of the trading, there's not a lot of information that we're going to be able to grab our hands with, or grab onto with our hands, I should say. So we'll just move along and let's go over to the gold market. Again, just going sideways, building energy for that next move higher. Gold is in a very, very bullish position. Each and every day, if it trades lower, it seems to recover rather quickly, and that's a sign of bullish behavior. It's buoyancy underneath the market. The gold market is certainly putting in a bullish pattern, and it's just a matter of for how long does this pattern persist before making the move higher. The longer the pattern goes on, the higher and the stronger the move out of this pattern will be. If it were to go up now, I'm not 100% convinced we'll get up to the 200 period moving average or the 1275, but another series of days sideways, a little bit back and forth, maybe another retest of the 20 period moving average or 1225, and we'd be in some business. But frankly, I'm not sure we'll get that test. It's very bullish underneath the gold market, and my feeling is if we do see a crack in the stock market, that will likely be a catalyst for gold moving higher, and they'll pin it on the quote-unquote fear trade. Whether that's the case or not, we're not making a trade based on that. I'm just giving you an opinion. It's not a technical fact. It's not anything based on the charts. What the charts are telling us is gold is making a bullish consolidation pattern. This generally leads to higher prices. Period. End of story. Going over to the silver market. Same story with silver. We're trading in the upper range. We're consolidating underneath the 200 period moving average. When silver hit the 200 period moving average once or twice, you would think that it would pull back, and it began to once or twice. But the reality is that the more silver hugs the 200 period moving average, the more time it spends hovering right beneath the 200 period moving average, the more likely it is that silver will break to the upside and begin a run towards A, $18.50 and B, $19. And that's the more likely scenario the longer we hover just underneath the 200 period moving average. What we're doing is we're making bullish consolidation underneath the 200 with the 50 and the 20 upsloping right underneath. The market's in an uptrend. There's no doubt about it. This is a bullish market until this uptrend is broken. And this uptrend, a little bit unlike the gold market, this is a different look. But basically what you have here is a trend channel. And while the lines I'm drawing are relatively sloppy, these trend channels are relatively accurate, and the market will stay in this channel for a period and could be an extended period of time. The trend doesn't change until the bottom portion of this channel is broken to the downside. That could come now, or it could come 6 months from now. There's no telling exactly when it will be. We may have other indications that silver is doing something else rather than being bullish. But right now, as it stands, along with this channel is bullish until it's broken to the downside. So you have somewhat of a safety net on the downside, and it almost coincides, not quite, but it coincides somewhat with where the 200 period moving average, the 20 period moving average is right now. But all in all, this is in an uptrend, and consolidating below the 200 generally will speak to higher prices coming. Let's check out the action over in crude oil. You can see the obvious importance of 54.60. Today's high, 54.60. Yesterday, we pierced through it, but you can see all the days that we spent challenging 54.60 or within pennies of that number. Today happened to be the exact high of 54.60. Fell back down, but we did stay above the 53.79, and for my work, that does leave the crude oil in a more bullish position, and that leaves the door open for higher prices, namely getting back above the 54.60 to challenge some higher prices. But it needs to prove itself on the upside, and frankly, in order for any activity to get going on the upside, crude needs to challenge and close above on an hourly basis, consecutive hours obviously first, the $54 area. Until and unless that happens, then it's going to have a difficult time and continue to get rejected. Long term, this is a bullish pattern, but crude has a tendency to get very, very whippy intraday and can have wide intraday ranges and can drive traders bananas if you're so inclined to trade in crude oil. But right now, we are in the bullish position above 53.79. We sit at 53.92 after the 4:30 p.m. Eastern Standard Time. The inventory report came out. There's 2 inventory reports during the week. One comes out now and one comes out at 10:30 on Wednesdays, but that's delayed until tomorrow because of the holiday on Monday. So those being the case, or those, what they generally have a tendency to do is move the market, and that's what happened. And you can see, if I bring up a 10-minute chart, you'll see how the inventory number at 4:30 moved the market in the obvious upward direction to get back above 53.79, and that's where we are. Maybe it makes a run for the 200 period moving average on the 10-minute chart. Maybe it doesn't. That's at 54.20. Maybe it gets up to 54.25. That's possible. But either way, we'll see. More interested in the long view, the daily chart, and we really need to get above 54.60 to get anything whatsoever substantial cooking on the upside. Remember, on the upside, there are higher prices at hand to the $59-$60 area based on the weekly chart. And when you look at the weekly chart, if you can see through the lines, what you can see here is an extremely tight, bullish consolidation pattern that will eventually either fail or break out to the upside, putting crude oil around $60 a barrel. All right, let's go back to the daily and we'll move it along. Let's go over to the bond market, look at the 30-year bond. Back and forth today, saw a little bit of gyration around the Fed minutes that were released today, as well as in the gold market. We saw that market move when the Fed announced or released their minutes, but they're really nonsense minutes. They're just what the Fed wants everybody to believe was discussed at their most recent meeting. Who knows what was discussed? What the minutes are is just a watered-down version of whatever they want you to know. But getting back to reality, the bond market was up and it was down into the moving averages, bounced off of them, and you can see here we sit right around the important 151.10 number. That number remains important day in and day out of late, and if the bond market wants to get anything going on the upside, it really does need to get going. Otherwise, if it gets back below the 50-period moving average, which is the blue sloping trend line, if it gets back below there on an hourly basis and begins closing below there on an hourly basis, then lower prices are coming and we'll go right back down to 149 most likely. So we really need to get going above 151.10, and we need to get some solid closes if we're going to challenge the upside in the bond market. The bond market would be helped out if we did see some kind of downward pressure or at least a sell signal in the stock market, but that is not what we've seen. Therefore, the bond market just continues to churn around. Net, from yesterday, no new information. Going over to the dollar. The dollar continues to hover right beneath the 50-period moving average, and this could be considered making a bullish consolidation pattern. If it is, similar to silver hovering underneath the 200-period, this hovering underneath and consolidating underneath the 50-period moving average generally will bring higher prices out of this consolidation or what would be a pullback pattern. We could look at this as an ABC pattern. Really doesn't matter what you call it, A, B, and potentially C, continuation on up. Doesn't matter what you call it. Everybody calls them something different. Doesn't matter to me. Pullback, consolidation. All I know is if we get above, stay above, close above the recent highs, namely also the 50-period moving average, then we likely have higher prices coming, but we still may have one more leg lower going, and we'll know that is the case if and when we do get below the 20-period moving average. If we do get below and stay on a closing basis on the daily chart below the 20-period moving average, the red sloping trend line, then likely scenario is we first go back down to retest the 99.60 area, and likely we'll go down all the way to the 200-period moving average down here at 97 and change. And that's the way I see the dollar. And with that, I'm going to give it a wrap tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.